Hello everyone, North Star VFD Consultancy welcome you to another video on International Financial Reporting Standards for Beginners. In this chapter we will introduce you, IAS1, Presentation of Financial Statements. We hope this chapter will help you to understand overall requirements for the presentation of financial statements, guidelines for their structure and minimum requirements for their content. Before beginning, we would like to introduce ourselves. We North Star VFD, a financial management consultancy, provides services of financial planning and analysis, budgeting, cash flow, financial reporting, accounting and This standard defines overall requirements for the presentation of financial statements, guidelines for their structure and minimum requirements for their content. What you are seeing now is the financial statements of some of the well-known companies. A quick look at these: Statement of Financial Position, Statement of Income, Statement of Comprehensive Income, Statement of Changes in Equity, Statement of Cash Flow, Notes and Disclosures. You may note that these financial reports follow specific structure, format, contents which are common for IFRS compliant financial statements, as all these financial statements are prepared complying rules of IAS1 standard for presentation of financial statement standard, along with all other applicable IFRS standards. IAS1 History. First time, IAS1 issued for effective use, from the 1st of January 1975, under the title, IAS1 Disclosure of Accounting Policies. In August 1997, IAS1 Presentation of Financial Statements issued, for effective use from, on or after July 1998, superseding IAS1 issued in 1975. In September 2007, IAS1 reissued, for effective use from annual period beginning on or after the 1st of January 2009. From 1975 until now, IAS1 standard has gone through several amendments. Previously mentioned are some of the major ones. IAS1, Presentation of Financial Statement Standard, prescribes the basis for presentation of general-purpose financial statements, to ensure comparability, both with the entity's financial statements of previous periods and with the financial statements of other entities. Its objective is to ensure comparability with entities' previous period financial statements, comparability with other entities' financial statements. This IAS1 standard sets: first, overall requirement for financial statement presentation. Second, guideline for the financial statement structure. And third, minimum requirement for the content in the financial statement. Scope and scope limitation of IAS1. A. An entity shall apply this standard in preparing and presenting general-purpose financial statements in accordance with international financial reporting standards. B. Other IFRSs set out the recognition, measurement, and disclosure requirements for specific transactions and other events. C. IAS1 standard does not apply to the structure and content of condensed interim financial statements. However, general features stated in IAS1 apply to interim financial statements. D. This IAS1 standard applies equally to all entities, including those that present consolidated financial statements in accordance with IFRS 10 consolidated financial statements, and those that present separate financial statements in accordance with IAS 27 separate financial statements. E. This IAS1 standard uses terminology that is suitable for profit-oriented entities, including public sector business entities. If entities with not-for-profit activities in the private sector or the public sector apply this standard, they may need to amend the descriptions used for particular line items in the financial statements. F. Similarly, entities that do not have equity as defined in IAS 32 financial instruments, example, some mutual funds, and entities whose share capital is not equity, example, some cooperative entities, may need to adapt the financial statement presentation of members or unit holders' interests. Purpose of financial statements. Financial statements are a structured representation of the financial position and financial performance of an entity. The objective of financial statements is to provide information about the financial position, financial performance and cash flows of an entity that is useful to a wide range of users in making economic decisions. Financial statements also show the results of the management stewardship of the resources entrusted to it. To meet this objective, financial statements provide information about an entity's assets, liabilities, equity, income and expenses, including gains and losses, contributions by and distributions to owners in their capacity as owners, and cash flows. This information, along with other information in the notes, assists users of financial statements in predicting the entity's future cash flows and, in particular, their timing and certainty. Complete set of financial statements. Complete set of financial statements include the following. 1. A statement of financial position as at the end of the period. 2. A statement of profit or loss and other comprehensive income for the period. 3. A statement of changes in equity for the period. 4. A statement of cash flows for the period. 5. Notes, comprising material accounting policy information and other explanatory information. 6. Comparative information in respect of the preceding period as prescribed by standard. 7. If an entity applies accounting policy retrospectively, or makes a retrospective restatement of items in its financial statements, or when it reclassifies items in its financial statements, then a statement of financial position as at the beginning of the preceding period should be presented. An entity may use titles for the statements other than those used in this standard. For example, an entity may use the title Statement of Comprehensive Income instead of Statement of Profit or Loss and Other Comprehensive Income. An entity may present a single statement of profit or loss and other comprehensive income, with profit or loss and other comprehensive income presented in 2 sections. An entity shall present with equal prominence all of the financial statements in a complete set of financial statements. IAS1 stipulates certain general features of financial statements. They are 1. Compliance with IFRS. 2. Fair presentation. 3. Going concern. 4. Accrual basis of accounting. 5. Materiality and aggregation. 6. Offsetting. 7. Frequency of reporting. 8. Comparative information. 9. Consistency of presentation. Let us look into general features of financial statements in detail. Compliance with IFRS, as required in general features of financial statement. An entity whose financial statements comply with IFRS shall make an explicit and unreserved statement of such compliance in the notes. An entity shall not describe financial statements as complying with IFRS unless they comply with all the requirements of IFRS. In the extremely rare circumstances in which management concludes that compliance with a requirement in an IFRS would be so misleading that it would conflict with the objective of financial statements set out in the conceptual framework, the entity shall depart from that requirement in the manner set out in this IAS1 standard, if the relevant regulatory framework requires, or otherwise does not prohibit, such a departure. When an entity departs from a requirement of an IFRS in accordance IAS1 standard, it shall disclose a. That management has concluded that the financial statements present fairly the entity's financial position, financial performance, and cash flows. B. That it has complied with applicable IFRSs, except that it has departed from a particular requirement to achieve a fair presentation. C. The title of the IFRS from which the entity has departed, the nature of the departure, including the treatment that the IFRS would require, the reason that treatment would be so misleading in the circumstances that it would conflict with the objective of financial statements set out in the conceptual framework, and the treatment adopted, and D. For each period presented, the financial effect of the departure on each item in the financial statements that would have been reported in complying with the requirement of IAS1. Fair presentation, as required in general features of financial statements. Fair presentation requires the faithful representation of the effects of transactions, other events, and conditions in accordance with the definitions and recognition criteria for assets, liabilities, income, and expenses set out in the conceptual framework for financial reporting. In virtually all circumstances, an entity achieves a fair presentation by compliance with applicable IFRSs, A fair presentation also requires an entity A. To select and apply accounting policies in accordance with IAS 8 accounting policies, changes in accounting estimates and errors. B. To present information, including accounting policies, in a manner that provides relevant, reliable, comparable, and understandable information. C. To provide additional disclosures when compliance with the specific requirements in IFRS is insufficient to enable users to understand the impact of particular transactions, other events and conditions on the entity's financial position and financial performance. Going concern, as specified in the general features of financial statements. When preparing financial statements, management shall make an assessment of an entity's ability to continue as a going concern. An entity shall prepare financial statements on a going concern basis unless management either intends to liquidate the entity or to cease trading or has no realistic alternative but to do so. When management is aware, in making its assessment, of material uncertainties related to events or conditions that may cast significant doubt upon the entity's ability to continue as a going concern, the entity shall disclose those uncertainties. When an entity does not prepare financial statements on a going concern basis, it shall disclose that fact, together with the basis on which it prepared the financial statements and the reason why the entity is not regarded as a going concern. In assessing whether the going concern assumption is appropriate, management considers all available information about the future, which is at least, but is not limited to, 12 months from the end of the reporting period. The degree of consideration depends on the facts in each case. When an entity has a history of profitable operations and ready access to financial resources, the entity may reach a conclusion that the going concern basis of accounting is appropriate without detailed analysis. In other cases, management may need to consider a wide range of factors relating to current and expected profitability, debt repayment schedules and potential sources of replacement financing before it can satisfy itself that the going concern basis is appropriate. Accrual basis of accounting, as specified in general features of financial statements. An entity shall prepare its financial statements, except for cash flow information, using the accrual basis of accounting. When the accrual basis of accounting is used, an entity recognizes items as assets, liabilities, equity, income and expenses, all the elements of financial statements, when they satisfy the definitions and recognition criteria for those elements in the conceptual framework. Materiality and aggregation, required as general features of financial statements. An entity shall present separately each material class of similar items. An entity shall present separately items of a dissimilar nature or function unless they are immaterial. Financial statements result from processing large numbers of transactions or other events that are aggregated into classes according to their nature or function. The final stage in the process of aggregation and classification is the presentation of condensed and classified data which form line items in the financial statements. If a line item is not individually material, it is aggregated with other items either in those statements or in the notes. An entity shall not reduce the understandability of its financial statements by obscuring material information with immaterial information or by aggregating material items that have different natures or functions. An entity need not provide a specific disclosure required by an IFRS, if the information resulting from that disclosure is not material. This is the case even if the IFRS contains a list of specific requirements or describes them as minimum requirements. Offsetting, required as general feature of financial statements. An entity shall not offset assets and liabilities or income and expenses, unless required or permitted by an IFRS. Measuring assets net of valuation allowances, for example, obsolescence allowances on inventories and doubtful debts allowances on receivables, is not offsetting. In addition, an entity presents on a net basis gains and losses arising from a group of similar transactions, for example, foreign exchange gains and losses or gains and losses arising on financial instruments held for trading. However, an entity presents such gains and losses separately, if they are material. Frequency of reporting, as required by general features of financial statements. An entity shall present a complete set of financial statements, including comparative information, at least annually. When an entity changes the end of its reporting period, and presents financial statements for a period longer or shorter than 1 year, an entity shall disclose, in addition to the period covered by the financial statements, a. the reason for using a longer or shorter period, and b. the fact that amounts presented in the financial statements are not entirely comparable. Comparative information, as required by general features of financial statements. An entity shall present comparative information, in respect of the preceding period for all amounts reported in the current period's financial statements. An entity shall include comparative information for narrative and descriptive information, if it is relevant to understanding the current period's financial statements. An entity shall present a third statement of financial position as at the beginning of the preceding period in addition to the minimum comparative financial statements, if a. it applies an accounting policy retrospectively, makes a retrospective restatement of items in its financial statements or reclassifies items in its financial statements, and b. the retrospective application, retrospective restatement or the reclassification has a material effect on the information in the statement of financial position at the beginning of the preceding period. In the circumstances described in above, an entity shall present 3 statements of financial position as at a. the end of the current period, b. the end of the preceding period, and c. the beginning of the preceding period. If an entity changes the presentation or classification of items in its financial statements, it shall reclassify comparative amounts, unless reclassification is impracticable. Consistency of presentation, as required by general features of financial statements. An entity shall retain the presentation and classification of items in the financial statements from one period to the next, unless a. it is apparent, following a significant change in the nature of the entity's operations or a review of its financial statements, that another presentation or classification would be more appropriate, or b. an IFRS requires a change in presentation. An entity changes the presentation of its financial statements only if the changed presentation provides information that is reliable and more relevant to users of the financial statements, so that comparability is not impaired. When making such changes in presentation, an entity reclassifies its comparative information. In this video, so far we discussed IAS1 standards, history, objective, scope and scope limitation, purpose, complete set of financial statements, required general features of financial statements. In the next video, we will discuss remaining part of IAS1, that is structure and minimum content requirements for financial statements. This is end of this video. Thank you for watching. See you next time with remaining part of IAS1.